As a dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you. Okay, so we're going through the how to build wealth. Point number one was increase the difference between your income and expenses. Point number two is save the difference and grow it exponentially over time. That's the simplest model. Let's talk about the first part. Pick a high-paying job. This is what Lynn Alden goes over in her article. Okay, Reed, picking a high-paying job. What's your thoughts on high-paying jobs right now?
High paying jobs. You know what, to tell you the truth, I don't even know what the highest paying jobs are in the country right now. Or like it seems like with AI and everything, it's hard to choose a path when all most jobs and industries are going to get disrupted. All I can say is speak for dentistry right now and say that despite all the shortcomings of dentistry, the average income is still higher, right? Top 2% of all jobs in the United States. So that's what I'd start is dentistry, especially if you become a business owner, has pretty high ceiling for income. And so if you're in dentistry and you're a practice owner and you can build a profitable practice, you have a pretty high ceiling, which will allow you to have that discretionary income and savings to invest.
Yep, I love it. So opportunity in dentistry. Andrew, what are your thoughts on high-paying jobs? Like if you had a kid that was going, going to college this year, where would you be, or would you even be nudging them into college? What is
Yeah, yeah,
your thoughts there?
yeah. I mean, 'cause we were talking about that earlier, some of the trade jobs and just kind of calculating that opportunity cost as college education keeps rising. And unless my kid had a very specific direction they were looking to go, I just don't think going for the 4 years and getting the liberal arts degree really makes you that much more marketable in today's market than before. I mean, the thing that I think you have to marry your passion with what you're good at. But to me, with some of the technology and things, I'd be looking for what the leverage. I mean, the software and those different things that you can create once and you can leverage to continue to make more. Whereas, we only have one set of hands, and we can only do so much in dentistry that the leverage just isn't there the way that some of the other the jobs are now in the market with AI, with technology. So to me, I'd be looking at saying, okay, you first got to figure out what you're passionate about, what's going to make you tick every day. But if it is something where you can see a path to ownership and creating or producing something that you can grow and leverage without just being able to, like us, be sitting at the chair every day, I would be looking at those types of avenues.
Yeah, no, that makes sense. If you want to get real wealthy, you got to be able to scale, right? You got to be in an industry you can scale. We were talking a little before about electricians and the growth of that industry, HVAC, all those hands-on trades. You don't have an education you got to pay for. You don't have to go, you don't have to waste time going to college, right? The delay everything that income over 4 years, and the demand is huge for these things. So, I think that's like one level, like something where there's a lot of demand. There's no caps on reimbursements, like you can charge more every year. So that's like one level of wealth building, right? And then what Andrew is alluding to, if you really want to build the wealth, right, you need something that doesn't require as many team members. Andrew, before the show, talked about some orthodontists who focus on Invisalign, digital, maybe not Invisalign, but digital orthodontics, right? They have 3 or 4 team members instead of 15. you're really able to scale that human capital, which is, we would all agree, right, is the hardest part of dentistry. Um, so I think those are some great points. Um, any other thoughts on picking a high paying job? I think the other one here is, I mean, how you build real wealth is owning a business in my mind,
Mhm.
right? And
Mhm.
so, Lynn Alden, in her article, talks about picking a high paying job because she's, targeting the largest portion of the audience. But I think if you really want to earn wealth, you got to build a business.
And I think the when you asked me the question the first time, I'm thinking of like the relevance of talking to, if the people who are listening to this are predominantly dentists, they've already picked their job, they've already chosen their career. So to plan another idea of like, hey, you probably didn't pick the right job, you should have picked something else. Like you have to deal with the track that you've chosen and just kind of optimize in it. And at least in dentistry, it's easy enough to run a very profitable small business. And so that is a huge benefit. You don't have to build a massive business to have a really good take home income. So as a dentist, that is. In other industries, the margins are smaller and you have to build a bigger business. But because dentistry has high margins, we've talked about what they're shrinking a little bit, right? The trajectory is that they're shrinking, but in general, dentistry is still a high margin small business. And so it's an easy one enough to start with a small enough team that you can have a pretty good income from it. So
And when I talk about income from dentistry, I mean, CE is one piece, but I think people miss the funnel here, right? So the funnel on patients into your practice, if you own it, right, is like exposure, marketing, whatever you want to call it. Now somebody comes into your practice. The biggest thing I push first is like understanding insurances, right? Like if you understand insurances on a very deep level, you're going to optimize your income on your like fee per procedure or per appointment. You're going to optimize that probably to the tune of like 20%. Okay, just tossing out a number. And then two, sales training. Dentists, we are terrible at communication.
mhm,
My friend Spencer Greer, he is one of the best guys I've seen at communicating with patients, and he sold door to door. I think it was alarms or something, security, right? Like he developed that muscle, right? And so all my buddies that went to BYU that sort of sold door to door, they do amazing in dentistry because they're really, really good at this piece, right?
mhm.
So you can give the same presentation. If your close rate is twice as much, your revenue is twice as much, right? So those are the two pieces that I think are key that most people miss. And then the third is the CE, right? And being able to do the implants, being able to do the Invisalign, the procedures that take less of your time, you get a higher dollar per hour. So that's how I look at maximizing like
Income
dentistry,
industry. Yeah.
your income in dentistry. How do you guys look at that? Reed?
We could spend like I could spend like an hour just talking about this side of things, right? Because and I'm sure Andrew can too, because we talked about the whole communication piece many, many times and how valuable that is in dentistry, whether you're a specialist, whether you're a GP, it doesn't matter. You can't do dentistry that people don't say yes to, right? Like that's just a big part of it. So, I mean, you're talking about marketing. I essentially think of it like this. You have to maximize demand within your practice, either through patient volume or patients saying yes to treatment, right? And then you have to be super efficient at delivering on that demand. And that is how you produce more in less time. So that's the only way you make more income in the dentistry because month to month, your expenses are fairly fixed. So how do you create a higher income? You do more within that month. You do more within that day. You do more within that hour. That's essentially how you maximize profitability because fixed expenses, once covered, and you start going past that, every dollar of dentistry you do now has maybe a 70 or 80% profit margin rather than a 30% profit margin. So that's how I think of it.
Love it. Andrew?
Yeah. Yeah. Same thing. I mean, as you look at that funnel, it's saying, okay, it's what's coming in the funnel versus what's leaking out the bottom. And so for me, I always feel like the first spot to start is stopping the leaking out. Because if you're going to pump money into marketing, if you're going to do those things, you want to make sure that those people who are scheduling are ending up in the consult, and those who end up in the consult are starting treatment, and each level of that system is really tight, so you're not wasting marketing dollars to drive people in who aren't ending up in the chair eventually. So it's saying, how do you make sure all those systems are tight first, so you don't start pumping money that's just going to walk out the door because you're not following up on those appointments, they're not coming for the consults. And so a big part of that for me has been making sure those systems are tight. And then the second piece that, and probably in the recent future, is just, that is kind of the same day treatment. I know it's big for dentistry and for orthodontics. It's when people are in the chair, it's allowing them to get going, not taking more of their time. And so once again, that just doing more with the time that you have and making sure you're not unnecessarily pushing things out, that you could save people time by getting it done that same day. So, clogging the holes in the bucket and then filling the schedule with people who are walking in the door that same day.
Andrew, when are you going to take your ortho practices and have pedo in the same like the same spot, right? Like you're doing your 6 chairs on one side, they're doing their 6 chairs on the other side, and you're just bopping over doing same day like closes on ortho and all those pedo patients. When's that starting?
Um, it's interesting to see kind of how that dynamics working across the country, because you kind of see it coming from both ways. You see, pedos bringing in orthos, and you see other areas where orthos are bringing in pedos. And so it's definitely, there's a lot of synergy in that. We have a great relationship with the group next door, and so we're in the same building as a pediatric practice, and so work pretty close with them right now. But I definitely think that there's a lot of room and opportunity for that to be able to combine under one roof. And so we'll see how things go in the future, but it is something that is good to keep your mind on.
It's hard to transition to that model, especially
Yeah.
when the facility isn't built with, 15 chairs.
Yes.
But
Definitely.
yeah, if you could just snap your fingers, right, it makes sense to kind of have them. Yeah,
Yeah, it's definitely peanut butter and jelly for sure. They probably go as well together as any other specialty combo, in dentistry.
yep,
Yeah.
100%.
Yeah. Can I say something? We'll tie into real estate just a little bit, because I was just on some asset management calls today on some multifamily properties. And I think dentistry is just like, we're very operationally minded. We're so good at understanding that funnel, right? How that all works and how you have to be good at every step of the process in order to maximize it. And we work so quickly and realize that within a day, every day matters, every hour matters. A lot of industries don't think like that. And so they move a lot slower. And I'm always frustrated by how slow things move, even within real estate, property management, operations in the property. And even today, we were the same thing, funnel. When you're talking about leasing up a property, right? You start with marketing, you start with calls, or market goes to calls, goes to showings, goes to leases. Kind of the similar to anything within sales, and how that process breaks down. And then we don't get the lease up, and like I don't have the data to be able to make informed decisions on that. Drives me nuts. So we're working on that on some of our assets, some multifamily. But I'm just thinking dentistry, because we're so operationally minded, are very good at thinking about it that way, and that translates to any business, whether it's real estate or dentistry or whatever. So
100%. I keep thinking of chemistry class. What's it called when you have like one variable up top and the one on the bottom, and then you have the next equation and you like cross out the one on the top and the bottom, like step by
yes,
step. You remember that? I
yes.
mean, I think of it the same way, the exact same way when you look at funnels, right? I just take those equations one after another and then cross everything out to get the exact number I'm looking for. Um, we could do that. That is probably too in depth, but okay, here's one that I think is kind of interesting. She mentions number two, make money with side hustles. How do you guys feel about side hustles for dentists?
Andrew, you want to take a stab at it?
Yeah. uh, I think you have those two differing thoughts. I think there's something always exciting about side hustles and doing something different and a change of pace. But I think you also have to look to see, okay, have you maximized your best source of income right now. And so with the practice, kind of those things that we're talking about, I think it's easy to start chasing something on the side that's going to make an extra 10, 20, 30,000, but you could make little tweaks in your practice that could have far higher ROIs. And so I think that it's a balance. You don't want to take your eye off of the thing that's going to produce the cash flow that allows you to invest in the investments that are going to really help move the needle as far as your financial freedom. But I do think if there's things that, you know, bring passion to you and you're excited about, I think that looking at those side hustles and things that can maybe produce other income streams in the future are valuable. But you've got to be careful of shiny object syndrome, that you don't walk away from the most important thing first to chase something that may or may not produce the same return.
Yeah, that's well
Well,
said. And
yeah.
I was just talking to a young dentist yesterday because he reached out to me and he's looking to buy a practice. He's a year out of school and he's like trying to do real estate at the same time. He's working 5 days a week clinically. And he was asking me, he's like, what should I focus on? And I'm like, I would just focus on one thing, practice acquisition, buy the best practice you can, get it performing, and then you'll have plenty of time to focus on real estate. And I'll say real estate as the side hustle. I always get frustrated. Sometimes if the side hustle is investing, then it's not quite as much of a side hustle as like, I'm gonna I'm gonna franchise into McDonald's or Chick-fil-A, like that's a whole nother thing. Um, that I would stay away from because that's very operationally demanding. It takes a lot of time. But if your side hustle is investing, is personal finance, then it's a little bit different. Anyway, I basically said my advice was ignore real estate for 2 years, maximize that practice income, and then you'll have plenty of discretionary income to invest after that. So just to tie it together.
Yeah, real estate's not that exciting if you have $20,000 to work with, unless you're wanting to, really get in and get your hands dirty or something like that. And there's people who've done it and they do it with no money, but if you have some gunpowder on the side, you can make things happen a lot quicker than
Yep.
than taking your eye off the prize too early.
Return on time. Return on time. You got to keep that in mind always.
I'd like to disagree with you guys just for entertainment value, but I can't. Ru- Rule of thumb, every time an investor comes to me, right? Like we go through like income, right? And if their income is less than 500,000, my advice is go take the dental insurance CE, go take the dental sales CE, go take the dental clinical procedure CE. Like focus on your business. Exactly what you guys said. If you're below 500,000, yes, like Reed mentioned, you can learn about investing, get smart about investing, but you do not want to waste your time on real estate or these other things that take a lot of time and expertise. Just yeah, grow your income 100%. So, all right. Okay, so how to increase your income and save more. The third one here, I think we already touched on. Start a business, full or part-time. In dentistry, I think this more applies to like, hey, you can be an associate and not have to deal with the employee piece, right? That's a nice gives you much more bandwidth, peace of mind. You can just go home, right? But if we're talking about the topic of this is how to build wealth, I mean, can an associate really build wealth at scale?
If they're at that income threshold that you said, but it's very hard to get to that income threshold as an associate. I mean, you can do it, but at 30% or 30% adjusted production that you're getting paid to make 500,000, you're doing 1.5 million with your hands. Whew, that's a lot. I mean, you can do it, but you're a fiend. You're the 1% of the 1% that can pull that off. So I just
One
say, yeah.
130 a month, right? Net production. So you're going to be working hard. Andrew, what are your thoughts?
Yeah, I think to get there, it's not only working hard, but I think it's having being willing to be geographically flexible. I think so many people are wanting to be by the water or in the mountains. And so if I know a couple buddies who go to Alaska and they're crushing it because they're finding the spot that maximizes that time for them. And so it's 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 much more difficult to do as an associate, but I think you can get closer to that if you're willing to sacrifice on other things or be flexible depending on what your priorities are.
Yeah.
And here's a question for you guys. If an associate, this is what I get sometimes. If an associate comes to me, whether they're or usually it's a specialist, right? But like an orthodontist or a peds, and they're like, yeah, I'm making like 400 a year as an associate. I work 4 days a week. Like, should I really take the lunge and be a practice owner or not? And the question, like, it's just a matter of, do you want to be a practice owner? And do you really want to maximize your income? Are you just good coasting? Because if like it's good, you like what you do, and like there's no problem with that. But like you'll go double your income, right? If you be a practice owner and do the same amount of dentistry. And so I've seen it where I've told a pediatric friend, like, dude, if you're making 400 as an associate, you're gonna make 800 as a practice owner. And he does. You know what I mean? As soon as he made the pivot and did like a year's time, he's doubled his income. So, but you have to want the have the chops and want to own. So you got to keep that in mind. But if you just from like a math standpoint, uh, it makes sense to own. As a business owner, you'll be more profitable. You have more levers to pull. So
Andrew?
Yeah, 100%. I mean, if maximizing time, we've just talked about that, saying, there's only so much leverage that we can do in the field of dentistry, and that, there's certain ceilings, certain things, but one of those ceiling caps that we can remove is moving from that associate to the practice owner, because then it's we are able to do and create the type of practice, the style of practice, and you're not having certain things skimmed off of the top. And so it really, once again, if you're wanting to do the side hustles, if you're wanting to do things like that, is how you maximize income in the dental field. It is through ownership. It is through equity in a practice. And so if that's the goal, is to get that high so you can do other things, you have to want it. You have to, it's not an easy path by any stretch of the imagination, but that is the maximization of this career path, is through ownership.
I'm going to take the contrarian point of view here. So, my wife and I moved into an area when our kids were small, a school district where there's no multifamily. It's all older, smaller homes, an older grade school, so it's not huge, but it's public. One of the highest rated in the state. And I'm hustle, right? Hustle culture, like just go. Uh, what was really interesting is I would notice how many families walk their kids to school every day in the morning and then walk to school and pick up their kids in the afternoon. And as I started talking to these parents, many of these moms were nurses, right? Like educated people who could be earning good incomes, but they stopped when their kids, when they started having kids or when their kids started going to school, they stopped working. So I'd kind of talk to them, and to them, they had rare clarity that this is what was most important to them in life, being close to the grade school, walking their kids to the school every day, picking them up every day. Like to them, this was the most important thing. So I think, when we hear like the 400K specialist, right? Like, if we're hustlers, our mindset is like, oh, you're not reaching your potential, you could do more, like that's our natural thing. But if you're making 400K as a specialist and you don't want to buy big things, right? You don't need the big life. You just need a small but nice house, that grade school, that time with your kids, like that's what's important to you, right? Like if that's your core, then yeah, like why own a business? It's a lot. It's stressful, employees, all those things, you know. So really it's about soul searching. So I don't want people to have that FOMO feeling listening to this. And if that's what most important to you and you've already created that, you can have a fantastic life as long as you feel good about it. That's what matters most. So good.
Yeah, I can't disagree with
Yeah,
that. I can't disagree with that.
agree.
Yep.
Okay, a little math here. How to achieve the growth rate. So we talked about income. And expenses is really personal, but we all, we all know how to spend less if we choose to do so. So let's talk about the third part, which is growing that wealth exponentially. So savings. So they talk about how to produce 0 to 3%. Linda's talk about 0 to 3% annually. Here are the simple ways to do it: treasuries, corporate bonds, municipal bonds, savings accounts. Um, any points you guys have on just savings accounts and how to save in these very low risk ways?
They're in today's market with interest rates as they are, it's easy enough to just have high yield savings accounts to not have to mess with the treasury market. That's just my thought. Because it's completely liquid. You can earn 4% on most like a Wealthfront or like Fidelity cash account or Gold. I can't remember what they are. There's several, and you guys probably know them. But you can earn 4, and it used to be 5% just keeping in that savings account. And so that's predominantly where I keep the most liquid funds. I'm sure that'll change over time if yield goes down on those savings account, but it's pretty simple, I think, right now.
Andrew, any thoughts on the 0 to 3% tier?
Yeah, I agree. I mean, the the money market accounts have been as high as they've been in a long time these last couple of years, so it's pretty easy to make 4 to 5%. And I also think, as we're going throughout this, kind of always marrying back the dental field and with the liquidity stance, you always, I think there's a lot of people who are so anxious to get their money in these higher returns or pay down debts or things like that. It's for a lot of my career was just being able to have that capital on hand to meet the needs of the bank for purchasing the practice or being in a spot to buy the real estate. And so sometimes having being in that liquid portion, even if you're in that 0 to 3 and not in those higher numbers, if that's going to get you to that thing that's going to produce the more money, then it makes sense keeping some of that money there if the bank needs it to qualify you for those big goals that you have. I just see way too many people pay their debt off all the way or do something, and now they're not in position to buy the practice, or they're not in the position to buy the real estate that would have provided a much higher return than some of the other things they put their money towards early.
Mhm.
Yeah, well said. I think the 1.2 here is many people are not aware, like municipal bonds usually are tax free. So yeah, that's a strategy I see some larger wealth investors utilize.
But
Okay,
there,
so
what's the yield on a muni bond? Is it like 3?
it's not good.
Yeah, it's
It's
still
not
like
good.
still like tax free on 2% or
I
3%. It's
I,
not a
I
lot.
think, yeah, I've read some articles on it, and people do it, so there's got to be a reason. Actually, there was one guy. What was his model? There was a really wealthy guy I was talking to, and he had a very interesting model using the muni bonds, and it actually was smart. And we'll cover that on another show.
Okay. Yeah.
Okay, so the next tier from 0 to 3% on your money is 3 to 8%. Lynn references preferred stock, peer-to-peer lending, and index funds. Okay, so this is the 3 to 8% tier. Any thoughts on the 3 to 8% tier? Andrew?
For me, it's I pretty much the high yield savings account falls within this, and otherwise I kind of ignore it because I don't this kind of 8% range, like I don't really, it's not a big part of my portfolio. I kind of focus on
Yes.
beyond that.
Yes.
Yeah.
Okay. So Reed and I we're a little different because we're active in real estate. Okay. So this is not a passive investment for us. And we personally have gotten very high returns on our personal real estate, right? So it's not just conceptual, it's reality. And when it becomes reality for you, you start taking all your money out of index funds because you're like, I earn so much more over here. Why am I still doing this? But in general, preferred stock, peer-to-peer lending, peer-to-peer lending, if you do it right, can be low risk. Preferred stock, I mean, you get paid before others. It's a good option. Index funds is what the most common investment type out there, right? And I have no problem with index funds. I think the liquidity is great. Being able to access your funds quickly. I think that's awesome. I love the simplicity, right? Anybody
Yep.
can set up go invest in index funds, and I love like Vanguard, like low cost
Yep.
fee. I don't have a problem with this strategy, but you're not going to get wealthy off the strategy, right? This is slow and steady, millionaire next door, like build wealth over 30 years in the dental chair, which isn't attractive to me. So, but if you're a passive investor, liquidity, like Andrew mentioned, is so important. So, in addition to having cash, having a good amount in index funds is not a bad idea. You can also get a little more sophisticated here, is you can, put your money in index funds and then you can borrow against that money, especially when interest rates are low. There's a site called IBKR. It's like Robinhood for like professionals.
Mhm.
And so they have the best rates for lending rates off of your portfolio. So, people talk about borrowing off of like your whole life insurance or whatnot. You can borrow off your stock portfolio on IBKR, and it's actually a pretty good strategy. So,
Andrew got kicked off here. It looks like he said he's in the waiting room again. Do you
oh
wanna?
yeah, I'll add him back here. Okay, while I'm adding him back, Reed, the next tier is 8 to 12% um, annually. And what Lynn lists here are high yielding dividend stocks, right? So that's one
Mhm.
tier within stocks. Emerging markets or other international stocks or ETFs trading at lower valuations than maybe the US stock market index. Hey, Andrew, welcome back.
What's that?
Back.
We're just going over the 8 to 12% tier here. So we have high yield dividend stocks, emerging market international stocks trading at lower valuations than like the US PE ratios, for example. High quality real estate investment trusts, cash secured puts, that's going to be too complicated.
So,
And then alternative investments in general. Um, okay. Now we're getting a little more sophisticated. Do you guys want to, did any of those jump out at you that you want to talk about?
well, the last one you were saying you're kind of talking about indexing. Depending on what index you do, some my indexes usually fall within this range, that 8 to 12%, because even they put the S&P falls within this range. So there's an S&P 500 index. So I don't know if, depending on where you draw the line on that, but
Uh,
um,
the S&P, okay, last 10 years, maybe 10%. Prior to that, let's say 8%, right? But with our forward PE ratios, if you just look historically, right? Um, Most of many experts, not all, say, hey, you're probably not going to hit those same numbers the next 10 years, right? Just because of our valuation metrics. So yeah, I agree. Depending on the decade, you may feel the indexes may fall in one of these two
so
tier.
so then I might not be the best one to speak on this, but this range here is kind of what I put my index portfolio like within my brokerage account. So
Yeah.
I use a lot of Vanguard or Fidelity indexes, ETFs that fall within these categories of either high yield dividends or emerging markets or international stock. And I really, there's like maybe seven of them that I invest in, and I just kind of allocate based on um, percentages that I've come up with talking to other professionals, and I just set it, forget it, and then rebalance from time to time. So it's the really kind of automated portion of like my investing. So it's not a thing I spend a ton of time on other than just setting those auto withdrawals and auto invest, and that's pretty much it.
And I think Lynn does the same. She has some like example portfolios that she shares, and similar for her. So yeah, any thoughts there?
Yeah, I mean, not a lot to add. For a lot of my stuff it's been just keeping it as simple as possible. Kind of say, you can get complex with your different allocations and stuff. And at a certain point for me, it was just like, all right, I'll put it in VTI and I'll roll. I'm not gonna spend too much of my mental capital on this right now, and that, not that that's the right way, but some point you can try and maximize so much that you're not putting in or doing things. It's kind of a set or forget portion of my allocation, and then focusing on other things.
And I think that's the right thing for most dentists, because once you get to this level, there's a level of sophistication, right? You can't
Mm.
with like broad S&P 500 indexes, you can just put the money in. I'm not too worried about somebody long-term investing that way. But when you start looking at international funds, you start looking at real estate investment trusts, it- you open up the opportunity to turn your average returns from like 8 to 10% to like 0 to 3% pretty quick, bouncing around between these different options. So unless you're like passionate, as Andrew mentioned, about this, and really read a lot of books on this, spend a lot of time on this, I mean, the author does, right? But like, if you don't, I would not recommend jumping in this tier. It can be very destructive. So, okay, the next tier. So we went 0 to 3, 3 to 8, 8 to 12. Now we're in this 12 to 15% annually. Okay. And the two pieces she mentions here are top quartile private equity. So not all private equity, but private equity that's actually performing, that's actually doing well. And then direct real estate investing. Okay. Who wants to start? Andrew, you want to start on this?
Yeah, I mean, with the so many of these things is access to deals. I think a lot of people, everyone looks at this chart and they're like, yeah, I want to be in the 12 to 15. I want to be in the 16 plus. Like, yeah, that sounds awesome. But more so even than the sophistication continues to rise. And so it's not only is it finding deals, because you can, if you're on Facebook and you start looking at real estate, then all of a sudden every single Facebook targeted ad is a 501c syndication deal, and you're going to make this IRR. And so you kind of get into that level, and it's not only just finding the deals, but it's starting to assemble the knowledge and the supporting cast of trusting people who this is what they do, this is where they are, and building that team first before just starting to blindly put the money into these different buckets. And so I think that's where a lot of the people are, is they're like, okay, yeah, we want to start getting into these groups. We want to start being in the area, but it's figuring out who to trust, and who you want to make the long haul with it. And that's the bigger piece in my eyes, once we start to get into this area, opposed to just finding a deal that is real estate or is one of these things and checks the box.
Yep, 100%.
You're
Reed?
looking at me. Oh, you want me to go for it? Yeah, I think what Andrew said is absolutely right. I think there's access to opportunities, and then being able to vet those opportunities. Like that's the muscle, the skill we're talking about here. Like once you get to this level, it's that there. Like where are you sourcing these opportunities, and how are you vetting them so that you can actually lower your risk, because you are going further out on the return, but in doing so, you might be also going further out on the risk profile as well. And so they tend to go hand in hand. And so the one nice thing about this, though, unlike investing in the stock market, is that there is a control aspect, right? There is a skill that you can spend time and get really good at. And so you can lower your risk over time, participating consistently within these buckets of private equity and real estate. Like specifically us, we talk about real estate because we tend to do a lot of real estate, and every year we learn and we get better. And so we like to participate in this area because we get asymmetric returns relative to the other buckets, right? But in doing so, we are taking on risk, and we are spending a significant amount of our time to try to get good at this. So,
A lot of time,
yes.
absolutely. So top quartile private equity. What this is referring to is not all private equity is the same. Some are going to perform better than others, right? And how do you vet that? As a dentist, I mean, that's like 5 years of work learning how to vet private equity, right? And so it's what it's saying here is you can't just invest in private equity. You got to get good at it, right? It's just like anything else. So like I was talking, I think maybe I mentioned last week's show that I was talking to like a family office guy. He's like the family offices, right? They have sophisticated people helping them. Their average annual return is 7%. Okay. So even with like smart people helping you, it doesn't mean you're going to be 12 to 15%. And then private equity, like we talked about with dentistry, right? Like when debt is expensive, private equity's models of acquiring business and helping businesses grow and selling them gets hamstrung. So just because private equity did good the last 10 years doesn't mean they were doing good the next 10, especially if debt remains high. It gets much more challenging for private equity to achieve those returns. So no, I don't recommend people investing in private equity until it's a passion of yours. You do your 10,000 hours, you really understand it. It's similar with like business investing, like Series A, Series B, startups. It's the same thing, right? You're going to get slaughtered. Um, yeah, it's very hard unless you're an expert. The next one, direct real estate investing. This one's much more approachable, right? You can buy the building that your practice is in. You can buy the strip mall that you think is going to do well across the street. You can buy the duplex that's 2 blocks from your house, right? Real estate is tangible. You don't have the massive loss in values or the massive loss in cash flows. You can hedge those risks. So this is much more accessible to dentists. And the problem that these guys mentioned is, but if you're not spending the time and learning the chops, likely you're not going to perform at like the 16% average that I discussed, right? You're just not going to. The two ways to how you really earn interest is buying at the right price, right? So you got to be super sophisticated to understand what is the right price. You got, and then the second part is you got to add value, right? How do you add value? Fixing up buildings, which is like construction, finding new tenants, which is like brokerage, right? And if you're not an expert in real estate brokerage, you're not an expert in finance, you're not an expert in construction.
Prop- Property management
Property
operation.
management, I mean,
Yeah.
even property management, yeah, you can get a little bit of a tweak, but it's not the same as it's not as important as the price you buy at and the value add piece, right? It's yeah, so 100%. So yeah, so that's why like, Reed, Andrew, myself are like, look, I love real estate. I'm going to keep doing real estate. And we just go tell our friends like, hey, come along and invest with us. And we would all love to just make it like a simple like napkin model or like 1 page contract. Like, hey, come invest with us. The whole like syndication piece, like we don't like it either, but it's SEC required. So, a lot of the dentists are like, I don't want to invest in syndication, blah, like I don't like that structure either. But like once you get large enough with enough partners in a deal, it is required by the federal government to do that. And so just understand when you look into real estate, if you want to do it yourself, no problem with that, but get your practice profitable first, 500K or more you're taking home, and then really do the research, right? Be passionate about it, be something you're interested in. If you're not passionate about it, you don't want to put in the time, but you do want this higher yield, right? 12, 15, 16% or more, then find somebody you really trust, okay? And don't diversify with 10 different people, but because you can't build trust and really understand and get to know 10 different people. You can diversify in deals, you can diversify in asset classes, but don't diversify with that many who's. You'll never be able to truly understand them and what they're doing. You just want a handful, 2 to 3 who's on your real estate investing. Any other thoughts, guys, on 12 to 15?
Yeah, I think, there's the spectrum of investors. There's the, read every group, every book, everything, and spend 5 years researching real estate and then never putting money into a deal. And then there's the 6 gun shooters, sling from the hip, don't look at anything, put their money in because the number that it's going to be a 30% return, and so you've got both ends of those spectrums when you're dealing with investors. And so I really like the who, not how. But I also think you not every not every deal is going to turn out, not every deal, and you've got to have to say, like, do I have the grit to maybe go into that first deal or two, not knowing everything, but knowing this is a space that I want to be in, doing the best research you can, and recognizing that, okay, I may not get the return that I wanted. I may not get all this back, but guess what? You're going to learn a lot of value up front. And, after, I my first syndication deal going in, and everything sounds awesome. Whenever they're pitching you a deal, everything sounds awesome. It's a slam dunk. It's all these types of things. But then after you go through, you're like, okay, well, this was a new area they were investing in. This was a much larger asset class. They've been doing a lot of $2 and $3 million buildings. This was a 20 something million. This is a new process, and you can look in hindsight, see some of those things, and then you get to recalibrate for that next deal, having some of that experience. And so then all of a sudden the next deal, you're like, okay, well, they have 3 similar properties in this area that the management team is actually in on the deal. The vision and values are starting to align. Like you start to see these certain pieces that you're like, okay, I feel better about this deal. This deal makes a little bit more sense. And you still aren't going to know everything, because each rep you gain that perspective, but you have to be willing to get in and to try it, and recognize that you may not get a home run the first time, but if it's something you're serious about, you have to start getting the reps, and then you feel more comfortable putting more money in, and you figure out your who as well, and you figure out, are these the people that I really want to go the distance with?
Yeah, well said, Andrew. I call it, you have to eventually pay to play, right? Like eventually you got to lace up those sneakers and step onto the court. Like you might take some elbows to the face, right? But that's the only way you learn. That's the only way you learn. So, of course, we want to win every game we play, but eventually you just have to play. So, and that involves putting your money in and getting serious about it. So,
yeah, experiential learning. I mean, that's how you learn, right? And so whether you're investing or doing it yourself, maybe don't do the $10 million building on your first one, but read a little, do one, read a little more, right? And then partners, right? Like I always go with partners when I'm doing something new asset class, new weight class, right? Like I'm bringing in partners, I'm mitigating my risk, I'm learning how other partners operate at that level. Like it just, yeah, it reduces stress, peace of mind, right? Different people just bring different value. Like on one of my partnerships right now, um, the guy has his HUD card, right? So we can get HUD loans, right? Which are the granddaddy of all loans. They're the best loans out there. And if it was just me, I wouldn't be able to get them, right? So we have the option to increase cash flows and reduce risk with HUD loans. Another one, like his wife's an interior decorator that does like massive commercial interior decorating, right? So like his wife's fully like engaged, right? It's not one of those things where like, oh, is this strategic partner gonna really deliver for us? I mean, she's good and she's focused, right? And so yeah, I think partnering too on areas of, when you jump in, I would recommend partnering, especially if it's any significant size. Okay, I think we'll cover one more thing here, and I think this is probably going to end up being a two-parter. There's some other great content here. So the last piece for this one is how to produce 15% plus annually. Lynn mentions be a world-class investor and start a successful business. Reed, do you want to comment on those two?
I think we hit the successful business aspect. I mean, depending on, I think most dentists, if you're going to own your own practice, you probably will generate a 15% plus return from owning your practice, just as the business owner. So, I mean, it's going to be much higher than that on average. But so I think you're done there, right? You can just let that be your start a successful business and check that box. Whether you want to do 10 practices or whatever, you can. But one is good. Be a world-class investor. That's kind of what we were alluding to in that last 5 minutes there, I think, is if you're going to choose to be a world-class investor, you have to choose what you're going to invest in, and be consistent with that and specialize and get your 10,000 hours and learn. So we've chosen real estate. Probably not considered world class, right? But working towards it. Definitely working towards it. And I think, over a long enough time horizon, we'll get there. So yeah, that's what I would say. I think it's easy, and this is I everyone gets so upset when I say this, and I think sometimes Josh, maybe you hear this too, and Andrew, but it's not that hard to get a 15% annualized return in real estate. It's just not that hard.
It, it's not that hard when you know what you're doing. It's very easy to not get that return when you don't know what you're doing. And I think that's the majority.
Yeah, yeah. I sound like I feel like it rubs people the wrong way, and I don't mean to. I'm just trying to say it's possible, right? And as we've talked about, you can get 30, 40, 50% annualized returns when you hit the right deal at the right time. So I'm not saying it should be a guarantee or people should think that way. But when it's kind of like practice ownership. When you know the ceiling is there, you're like, okay, this is a game I want to play and I want to get good at it.
Reed, you and I, okay, and I'm sure Andrew here too, made really good money in dental, right? Like we're making really good money in dental. So for us to take our energy away from something we're already making really good money, it has to be better. Right. And so like you and I and Andrew would not focus on real estate if the returns were index fund like, right? 5 to 8%, 8 to 12%. If that was our experience in real estate, we would just be like, oh, I'm just going to do index funds because I don't have to do anything and it's liquid, right? That would be our choice.
Yep.
But we've learned, like we had an interest in something, we started doing it, and the feedback we got through our return profiles was, wow, this is fantastic, and it's much more scalable on the time side than dentistry,
Yep.
right? Like
Exactly.
that extra hour on real estate gives me a much higher return on my time than the extra hour on dental.
Exactly. Yes.
And I can retire and still do real estate. I can't retire and do dentistry because once you take your eye off the practice, things start to unravel. So, uh, well, guys, thank you so much for hopping on the call today. You guys have fantastic insights. Andrew, I appreciate you. And I like your outfit, bro. Man, the color that
I know
makes me happy.
you guys were the V-neck bros. I was like, maybe if I unbutton one, there are flamingos, birds flying a V. So, I did what I could. I don't think I own a V-neck, but maybe next time.
You got the pop of color. We're
Yeah,
kind of
yeah.
muted.
I
You're the color.
uh,
You're way more exciting than us. I love it. It's a nice look. All right, guys. Well, thanks again for tuning in, and we'll talk to you next week.